Welcome to the part 2 of our annual income tax computation and preparation training. So let's start. Before we proceed, let's recap first what have we discussed last Wednesday or the last time, the last training that we had. So we discussed all about income tax. We determined whether how individuals and corporations are being taxed and what are the inclusions and exclusions to the gross taxable income, as well as the allowable deductions, the requisites for the deductibility and limitations. So still we're in the topic of discussing the details about income tax. Now that we know um, the basic information that we need to know, we'll proceed with the filing and preparation, preparation and computation of the income tax returns. So we have two kinds of annual income tax return: the 1701, which is for individuals, and 1702 RT for corporations. So how do we compute for the income tax due? We have the trial balance. So whatever in every businesses. So let's say individuals may not have trial balance in a formal sense, but uh, every um, every businesses, every um, uh, practice has an accounts or an accounting system that it follows. So this is how we uh, this is how we start. So first, let us have or the first ito yung pinaka main na source. This is the main source of information on how we can arrive or we can compute for the income tax due. So when we have the trial balance, we can prepare the profit and loss statement, which will be used in the preparation of the financial statements. So in the trial balance, there are certain reconciling items that we need to identify. So once we identify those reconciling items, we need to classify whether it is a temporary or permanent difference. Then, once we classified it, we can now add or deduct these reconciling items from the profit and loss statement to determine the tax base. Then compute for the tax payable and prepare the ITR. Simultaneously, when we were able to classify the temporary or permanent differences, we can compute for the deferred taxes. And we will be ready now to prepare for the disclosures. Preparation of the disclosures and preparation of ITR usually happens simultaneously. So it does not necessarily that uh, this one or the preparation of the ITR would come first or the preparation of disclosure would come first. Okay, so let's discuss in details how do we compute for the income tax due. So let's go to the first step. Prepare a profit and loss statement. So in every company, in every business, in every transaction, or in every month, even individual taxpayers, they want to know how they stand or what is their financial standing. So most likely there's always a profit and loss statement that is needed to be prepared. So usually a profit and loss statement includes the sale of service, less cost of goods and services, plus other income, less expenses to arrive at the net income. So this is a basic form of profit and loss statement. Next, next step, identify reconciling items. We have identified previously what are the components or the inclusions and exclusions of gross income and the allowable deductions. So for the gross income, reconciling items refers to those items that are non-taxable by nature or non-taxable for tax purposes. So it may be tax exempt or income may be subjected or may already be subjected to final tax, or it could be a deferred income. It may be non-taxable this year, but it could be taxable the following year or in the succeeding years. Or non-taxable income that may not be uh, taxed forever, or it could not be taxed even if during the succeeding years. So for the allowable deductions, these are reconciling items refers to those that are non-tax deductible. So those non-tax deductible items could be uh, deductible in the future or not. So this non-tax the items of non-tax deductible are as follows. It may be due to limitations. So we have three kinds of limitations as discussed previously. The first one, uh, the charitable contributions, the interest expenses, and then the uh, representation expenses. So other limits of expenses, which we also discussed last last time about rentals and then um, retirement benefits. What else? We have also discussed what how to uh, how to determine how much the allowable deductions for each type of expenses, how much is allowed, how much is not. Deferred expenses, so these are expenses that may be paid ahead but will be expensed in the future. Accruals, these are expenses that were already incurred but were not yet um, determined as to the exact amount of the expense or income that should be recorded or taxed. Other items of expenses that are non-deductible in nature, for example, bribes, kickbacks, penalties, income tax, etc. If it if an expense is not substantiated by an adequate proof, it may be considered as non-tax deductible. Another criteria or another reason for non-tax deductibility of expense is the non-subjecting of expenses to withholding tax. What else? If the expense or the income, uh, if the expense is um, if the expense is not or incurred, if the expenses is incurred not within the taxable period, then it is considered as non-tax deductible. Next step, classify the reconciling items as temporary or permanent difference. So we have an accounting income and tax income. Generally, the expenses for accounting income and tax income are the same. However, there are certain expenses that may not be equal when it is recognized in the accounting income and when it is recognized in the tax income. So why? So there are certain reasons why accounting income and tax income differs. So accounting income is generally based on the fair value, while tax income, it is always based on cost or cash basis, but sometimes based on fair value. But generally, it was always based on cost. Accounting income uh, follows the principle of substance over form, while tax income relies on the form of the expense or income only. So in accounting income, there is a matching of income and expenses. Although in tax income, there is also a matching of income and expenses. They are more they are more inclined. The tax income is more inclined to the contractual rights and obligations of the taxpayer or the involved taxpayer. So accounting income basically is based on accounting standards. We have the frameworks, the financial accounting standards that it follows. While tax income, obviously, it is based on the tax laws. So we have the tax code. The differences of accounting income versus the tax income might be um, classified as temporary difference or permanent difference. Permanent differences are non-taxable or non-tax deductible in nature. So the the taxpayer only has the benefit of non-taxability for the same period only and not on the succeeding period. So kumbaga, i-apply lang permanent difference kung kailan lang siya um, during the same taxable year lang. So, hindi siya naki-carry over to succeeding periods. Unlike temporary differences, it could be a deferred tax asset or deferred tax liability, which is for deferred tax asset, it could be it could be deducted in the future, while deferred tax liability could be taxable in the future. Kumbaga, si permanent difference, wala ka nang magagawa kapag naging non-taxable na siya or non-tax deductible. Si temporary difference, it may be considered as non-taxable or non-tax deductible during the taxable year. However, it may be tax deductible or taxable in the succeeding periods. So what are the examples? Some examples of um, the reconciling items or temporary and permanent differences. So temporary, let's start with the temporary difference. So this includes deferrals, income, and expenses. So what are those deferrals? Those that are prepaid. So prepaid rent, prepaid insurance, um, prepaid taxes. So overpayment of taxes are considered as deferrals. So that a taxpayer may carry over and use in the future as tax deductible. Provisions, losses, and other expenses. So what are the examples of provisions? Provisions for bad debts, provisions for inventory losses. As discussed previously, so provisions are non-tax deductible, but it could be deductible in the future once the amount of or once the actual bad debts or inventory loss could be determined already. Next, accruals of income and expenses. Accruals are just mere estimates, similar to provisions. So, accrual of income or accrual of bonuses. So, accrued bonuses or accrued expenses. So, since these are just mere estimates and there is no um, accruals are basically based on the historical historical data the company or the taxpayer has. So let's say, for example, previously in the month of January, they have 100,000 expense. Lapit na lang tayo sa November. In the month of November, they have 100,000 expense. So in the month of December, they do not have yet the actual billings for, let's say, utilities, rentals, or um, rentals, and then um, billings for communications, internet, etc. We normally, or companies or individuals normally, receive billings a month after the amount, the expense was incurred. So that's why there's a um, that is why we always consider accrual of income and expenses. Since the billing will not arrive at the same taxing period, so we need to accrue. However, since we are just estimating based on the previous month or previous year's data, so this is not um, or so this is not properly substantiated by any supporting document. So the amount of the expense is not actually the amount really incurred. So that's why. Next, unrealized gains and losses. So unrealized gains and losses um, could be unrealized this year, but it could be realized the following year. So that's why it is just temporary. Unrealized gains and losses technically is unrealized gains is not taxable during the taxable year since it is unrealized. While unrealized losses, at the same concept with unrealized gains, it cannot be deducted in the allowed deductions since it is unrealized. So for expenses to become deductible, it must be realized. So under the permanent differences, those incomes subjected to final tax are non-taxable forever. So they are not taxable. And then those that are exempt by nature or by law. And if there are expenses that has no proof or not subjected to corresponding withholding tax, and then if there is a recovery of previously deducted items of income and expense, then it is considered as permanent difference. So, since it was previously deducted or already, in example is in the case of recovery of bad debts, since it's already deducted for income tax purposes previously, then the recovery of the bad debts must be included in the gross income as a permanent difference. It's as if a new income to the taxpayer or the company. And out of period expenses. So all expenses must be recognized. All incurred expenses in a taxable year must all be recognized and declared and considered as an allowable deduction within the year it was incurred. So, hindi pwedeng lalagpas. So, if there is an expense of 2020 and we are preparing for 2021 ITR, the expense from 2020 could not be carried over to the expense in 2021. So it could not be added. We could not add those out of period expenses to the current. So, yun. Otherwise, if these expenses would be discovered, or if there are expenses that out of period and was discovered later on during the audit, it will be disallowed by the BIR. Then it will be subject also to penalties, interest, and other and surcharge. Okay. Non-deductible duty limits. So since uh, since there is a limit to some of the expenses, so if these limits are will no longer be expense, or the non-deductible items or the non-deductible expenses due to limits could not be carried over to the following period as it is already considered as out of period. Okay. Next, step 4. We have prepared the profit and loss statement. We already identified the reconciling items and classified them accordingly as temporary or permanent difference. Now, we will add or deduct these reconciling items from the profit and loss or FS balances and determine the tax base for ITR purposes. So, first things first, you need to prepare a worksheet. So, whereas in the first column of your worksheet, there um, there is shown the accounting balances as adjusted. So as adjusted in the sense of audit. Under the second column, this includes the reconciling items, which is divided into permanent and temporary differences. In the third column, these are the balances as adjusted for tax purposes. So after preparing the worksheet, we post all the balances of FS or the P&L, and then the permanent and temporary differences, and then add or deduct all reconciling items to arrive at the tax base. So here is an example of the worksheet or here is an example on how to add or deduct or reconcile the FS balances to the ITR. So as you can see in the first column, uh, here the taxpayer has a total of 2.6 gross income that is recorded in the books. So however, there are certain reconciling items noted. So first one is interest income. So interest income is subject to final tax unless the interest income is uh, from or related to or connected with the trade or business or related to the sale or the nature of sale of service of the taxpayer, then it should not be considered as a permanent difference. So, and here in this example, interest income is subject to final tax. That's why we remove the 10,000 from the total taxable income for tax purposes. Dividend income. So, this is assuming that the dividend income is received by a domestic corporation from a domestic corporation. So, intercorporate dividends are exempt from the imposition of tax. So this is an example of a tax-exempt income. So since this is a tax-exempt income, we need to remove it from the total taxable income of the taxpayer. So equity in net earnings is the same principle as the dividend income. So it is a tax exempt. This is tax exempt by nature. So we need to remove it from the uh, total taxable income of the taxpayer. Next, unrealized forex gain. So this is an example of a temporary difference. So since uh, unrealized gain are initially not deductible in the taxable period it was incurred. However, it could be or it is considered realized the succeeding period, then it could be deducted for tax purposes. So, however, in this case, it is still unrealized. That's why we need to remove it as an allowed deduction. We need to remove it as an taxable income since it could be taxable in the succeeding period pa. So not this year, the following year. Next, sales subject to capital gains tax. Capital gains tax is an example of a final tax. So any gain from the uh, any gain from the sale of properties that is subject to capital gains should be removed or should not be subject to income tax. So that's why we need to deduct the amount as permanent difference. Realized forex gain. So since this is a realized, since this income is already realized, then there is no need for us to remove it from the taxpayer's taxable income. So from 2.6 million tax from 2.6 million accounting income, the taxable income now is lowered by 600,000. So the taxable income of the taxpayer after the consideration of reconciling items only amounted to 2,007,500. Next, let's try with the expenses. So in the first column, you will see the different types of expenses. Next are the amounts that was recorded or that was reported in the books of the taxpayer. Okay. Salary and benefits. Let's start with the salary and benefits. Usually, in the salary and benefits or the expense reported the salary and benefits usually have accruals. So, however, in this example, we do not have accruals. Accruals of bonuses, accruals of salaries, and etc. Retirement costs. So, this retirement costs are represents the actual payment of retirement, the retirement pay. So based if this is assuming that a company has a reasonable private plan. So in this case, the actual retirement cost for the year must be considered as a temporary difference. While the past service cost of 20,000 shall also be deducted as temporary difference since we only need to amortize, or there must only be a amortization, or the amount that should be deducted must be equivalent to 1/10 of the total past service cost. So this is just an illustration. So instead of allowing the whole 20,000, we only allow 2,000 as the deductible expense. Rental, there are no adjusting entries, but if uh sorry, it is not an adjusting entry. There are no reconciling items. So, however, if as discussed last time, if there is a difference between the accounting or the audited audited amount of rental expense reported in the FS versus the taxable the actual payments during the year, then it should be considered as a um, uh, temporary difference. Equity and net loss. So the same, it's the same concept with the equity in net earnings. So you just remove it as a permanent difference. Unrealized Forex loss. So since this is still unrealized, we need to temporarily uh, deduct it from the taxable uh, from the tax deductible expenses. So, ang dapat lang natin i-recognize is the realized forex loss amounting to 7,500. Provision for bad debts are not taxable, are not tax deductible. So that's why we need to remove it as a temporary difference. Provision for inventory obsolescence, the same. We should remove it as temporary difference since these are mere provisions. Deficiency income tax, penalties, and surcharge is not taxable or is not tax deductible. Since deficiency income tax is already a tax that must be paid, penalties and this pertains to deficiency income tax pertains to the uh, previous income tax due based on the uh, based on the prior year tax resulting from PIR audit. So even though um, even though we have paid for it, this is not an actual expense that must be claimed by a taxpayer as um as a non as a tax deductible item. Sabi nga natin last time, 'di ba? Hindi siya kasama. Philippine income taxes are not taxable or are not tax deductible. So or are not allowed as deductions to the income. Penalties and surcharges are not are not deductible or are not allowed as deductions since these are not indebtedness by nature. These are um penalty nga, 'di ba? So you do not have the right to claim the expense. Interest expense, this is um the 33% of the interest income that was subjected to final tax. In our previous case, the interest income is 10,000. So 33% of it is equivalent to 3,300. This amount must reduce the interest income that should be deducted for income tax purposes. So from 777,500 expenses, it was reduced for tax purposes to 561,200 only. Okay. Next, after reconciling, we need to compute for the tax payable. How to compute for the tax payable? First, we need to determine the taxable income. So this is already net of the reconciling items. Compute for the tax due and deduct tax credits, if any, such as income tax paid from previous quarters or the quarterly income tax payments, creditable withholding taxes, prior year excess credits, and excess minimum corporate tax. So individuals, we already know that individuals are subjected to graduated income tax rates from 0 to 35% and special income tax rate of 8% at their option. While corporations, domestic, resident, whether domestic, resident, and non-foreign, is subject to 30% corporate tax in general. However, there is an additional type of tax that must be considered for corporations. So this is what we call the minimum corporate income tax. So the minimum corporate income tax is a 2% tax imposed on the gross income. Gross income meaning sales less cost of sales plus other income. Of whom? Of the domestic and resident foreign corporations only. Non-resident foreign corporations are not subject to the imposition of the minimum corporate income tax. It is imposed the imposition of this tax begins on the fourth taxable year immediately following the year in which the business commenced its operation. The term the business commenced its operations is the date of registration with the BIR and not when the taxpayer actually started his operations. So it is the date of registration with the BIR. So regardless of whether they started or they were issued a certificate of registration, kahit nasa gitna pa yan ng taon, ang count natin, the count of the 4 years is from 2012, 2013, 2014, 2015. In 2015, the domestic corporation and the resident foreign corporation will be subject to the imposition of the MCIT. So first things first, what is the rationale of the government? Why did they impose the minimum corporate income tax? So there is a prevailing practice in between corporations that they tend to overclaim deductions to reduce their income tax payments. So this scheme, for this scheme to be minimized or for evasion, possible tax evasion, and to minimize the tax avoidance schemes of companies or corporations, the government think that imposing thought that imposing of the minimum corporate income tax would prevent or minimize these schemes. So how is the minimum corporate income tax is imposed? So number one, whenever a corporation has zero or negative taxable income, assuming that um, the taxable income is resulted to a loss, still a loss after deducting all the necessary items to be deducted, then the taxpayer is taxable on its gross income at 2%. Second is whenever the amount of the minimum corporate income tax is greater than the regular corporate income tax. So these are the two conditions for a minimum corporate income tax to be payable. Who are the entities exempt from MCIT? So under the domestic corporations, the educational institutions and nonprofit hospitals that is subject to 10%, depository banks under the expanded foreign currency deposit system, whose income on foreign transaction is subjected to 10%, and those under special income tax based on Philippine Economic Zone Authority law and the Basis Conversions and Development Act. For resident foreign corporations, those international carrier that is subject to 2.5%, OBUs whose income from foreign currency transactions is subject to 10%, and ROHQs that is subject to 10%. So they are the exempt entities from MCI. Limitations. In the case of a domestic corporation whose operations or activities are partly covered by regular income tax and partly covered under a special income tax system, the MCIT shall apply on operations covered by the regular income tax system only. So, as discussed earlier, yung special income tax is covered by another law. So that's why um, ang comparison lang natin dito is when there is a minimum corporate income tax under those um, under those that were computed under the regular income tax system. Relief from MCIT. So, a company or a taxpayer may not be subject, or the imposition of the MCIT may be suspended if there is sustained substantial losses on the part of the taxpayer. However, the taxpayer must prove that there is a sustained substantial losses being accounted for. So it could be these losses could be due to a prolonged labor dispute, force majeure, or legitimate business reverses. So next, now that we have been able to determine the taxable income, um, compute for the tax due, whether RC, we were now able to compute for the tax due, whether regular income tax or minimum corporate income tax. Now, let's go to the other deductions. Deductions for tax purposes only. So, creditable withholding taxes. Creditable withholding taxes, these are taxes withheld by customers. So, these are evidenced usually by PIR form number 2307. So again, creditable withholding taxes is withheld by customers, not the taxpayer itself. So for every creditable withholding taxes, there must be a supported certificate of withholding. So that is BIR form number 2307. The creditable withholding taxes, or the certificate itself, must be in the name of the taxpayer as payee, customer as the payer. And these creditable withholding taxes can only be credited against income tax within the covered taxable period of the certificates. So if you have certificates from 2019 and you failed to include it as tax credits in 2019 ITR, then you cannot claim it as tax credit in 2020. Prior year excess credits. So prior year excess credits happens or results from if the tax credits during the taxable year or during the preparation and computation in the annual income tax return is greater than the income tax due. So this includes excess creditable withholding taxes. So although creditable withholding taxes might although creditable withholding taxes are claimable only within the year of the certificates, we can carry over of uh, the excess of creditable withholding taxes to the succeeding period, provided that it was reported in the ITR. So, hayaan nyo lang na lumobo yung excess credits nyo. Kung madami talaga siya within the year, hayaan nyo lang siya. Do not lessen the excess credits or huwag niyong babawasan ng sakto lang dun sa income tax due para maging zero. Kailangan lahat ng income tax creditable lahat ng creditable withholding taxes ay naka-report during in the ITR upon its incurrence. Apart from the excess creditable withholding taxes, we have overpaid taxes. So this one could be from the quarterly income tax payments. So this tax credits or this prior year excess credits are recorded as prepaid taxes, which the taxpayer can recover in the future or in the succeeding period. Excess credits, a taxpayer has the option to refund, apply for a tax refund, apply for a tax credit certificate, or carry over to succeeding taxable period. So, excess credits cannot be applied to other form of taxes. If, for example, you have excess, or if you have an overpayment of 1 million under the income tax return, you cannot use that as tax credit to value-added tax, withholding tax, DST, etc. So, this is only applicable to income tax returns. Although previously, some companies, although previously this scheme is being allowed, however, uh, yung mga latest rules, inabolish na yung ganong scheme. So, These are the only options that the taxpayer has. Could be refund, tax credit certificate, and carry over to succeeding taxable period. So, once the option to carry over and apply the excess credits against the tax due of succeeding taxable quarter or years has been made, the option shall be considered irrevocable for the taxable period and no application for cash refund or issuance of a TCC shall be allowed. So in the ITR, there are three options under the tax payable or overpayment. So whatever the taxpayer chooses as an option, whether refund, issuance, or carry over, it is already irrevocable. So if the taxpayer wants to apply for cash refund, then it is for cash refund. He cannot carry over the amount to the succeeding period. As same applies to the issuance of ATCC. In case the taxpayer wanted to carry over the overpayment, then he could use it as a tax credit in the succeeding period. However, he could not ask or he cannot ask for cash refund or issuance of ATCC kapag nagbago ang isip niya. Next, excess MCIT. So excess MCIT is whenever the MCIT or it results whenever or it arises whenever the MCIT is greater than the RCIP. So it can be credited to income tax due only if under it is in the regular corporate income tax position. Later, I will show you how do we compute for I will illustrate how do we compute for the excess MCIT and how it is being deferred. So similar with the NOLCO, the excess MCIT can be carried over in the next 3 succeeding taxable years. Please take note that the application of the 3 years for carryover purposes cannot be interrupted even if the taxable income is still subject to MCIT. If, for example, MCIT na siya currently, and then the following year, MCIT pa din, then MCIT pa din on the third year, the the running of the 3 years of the um, carryover is not interrupted. So, mag-expire pa rin siya on the third year. So, after we determine the taxable income, the reconciling items, and we already computed for the income tax due, we can prepare the income tax return. So the amounts to be reported in the income tax return must be the adjusted amounts. So this is after recon. So in the schedules, in the schedules, schedules 1, 2, 3 of the latest income tax return, the amount that the taxpayer must put in the return is already the adjusted amounts. So that is the taxable and tax deductible amounts or expenses. Please take note that the total taxable income in Part 4, Item 39, page 2 of the ITR must equal to the net taxable income or loss item in number 10 in the Schedule 5, page 4 of the ITR. And the details of NOLCO and MCIT in Schedules 3A and 4, page 4 must also be completed. So this is part 4 of the ITR. So as you can see, in the encircled portion, the item number 39, that net taxable income or loss must be equivalent to the net taxable income or loss under Schedule 5, which is on page 4 of the annual income tax return, or 1702. This schedule applies to the net operating loss carryover. As discussed previously, so this is a requirement of the BIR. Although in the EBIR form platform, you may not be able to um, complete complete it without complete the or you will not be able to validate the income tax return without completing the details under Schedule 3A. So under Schedule 3A, so the year that it was incurred must be uh, noted, the amount, the application, or whenever there is an applied NOLCO, the amount of NOLCO expired, how much applied this year. So that would be on letter E, then the unapplied portion. So this, the manner of presentation here in the ITR must also be disclosed in the financial statements. Next, Schedule 4, the minimum corporate income tax. This is the same with the NOLCO. So if this were not completed, or were lacking in the filing of the income tax, in the filing of the income tax return, then the MCIT and the NOLCO might be disallowed by the BIR. Also, similar to the NOLCO, it must be disclosed in the audited financial statements in the same manner as the NOLCO, or in the same manner as presented here by the BIR. So we're done on the income tax computation side, or the preparation of the ITR. Now, let's proceed with the um, preparation of the disclosures. So before you can prepare the necessary disclosures, you need to identify what are the deferred tax assets and deferred tax liability. So as discussed earlier, deferred tax assets, these are future tax, or this includes the expenses that were not um, uh, that were not deducted, that were not yet deducted for tax purposes, but to be deducted in the succeeding period. The deferred tax asset is already taxed at 30%. So, naka 30% na yung deferred tax asset natin. While deferred tax liability, kabaliktaran ng deferred tax asset, so these are not yet taxable in this period, but will be taxable in the coming periods. So for you to determine how much would be the balance of the deferred tax asset and deferred tax liability. By the way, the deferred tax asset and deferred tax liability must be um, reported on the face of the financial statements. So to determine the balances, so you need to prepare a schedule of deferred tax assets, deferred taxes, which includes the beginning balance, the additions and deductions to the balances, and the ending balance. So upon preparation, post all the temporary reconciling balances. So, so again, uh, the deferred taxes are temporary reconciling balances. So yun lang yung ipopost natin. Permanent differences were off the records na. So you need to add or deduct the prior year balance, which post all temporary reconciling balances, and then add or deduct to the prior year balances, if any. And then determine the ending balance of deferred tax assets and liabilities and multiply by the prevailing tax rates. Or, pwede naman, mauuna mo na i-multiply yung, kunin mo na yung equivalent tax rate niya para hindi ka na mahirapan. Okay, excess MCIT must also be included in the balance of deferred taxes. So, by nature, MCIT is also a deferred tax. NOLCO is a deferred tax kasi saan siya galing? Sa expense din naman siya galing. So, balances of the deferred taxes are required to be disclosed in the notes to the financial statements. So, how to compute for the excess MCIT and how to determine the deferred income tax. So, in our example, the company had the following actual and expected RCIT and MCIT for 5 years. So, year 4 na kasi the company is already subject to MCIT on year 4. So how much DTA should be recognized for the excess MCIT in year 4? So in year 4, we can note that the MCIT is greater than the RCIT. So sabi natin 'di ba, if the MCIT is greater than the RCIT, there is an excess MCIT that must be considered or recognized. So in year 4, the income tax due is equivalent to 80,000 since MCIT is higher than the regular corporate income tax. So tax payable in year 4 is equivalent to 80. In year 5, so the tax MCIT is still greater than the RCIT, so there's still an excess MCIT of 20,000. Income tax due is at, since higher pa rin ang MCIT natin, then the income tax due as well as the income tax payable is equivalent to the amount of MCIT. In year 6, the company now is in is in a regular corporate income tax position. So here, the income tax due is now equivalent to RCIT, which is 40,000. The excess MCIT that must be this income tax due must be reduced by 40,000 only of the excess MCIT from year 4. So in the end, tax payable is equivalent to 0. So the taxpayer, the company, has the benefit, obtained the benefit of not paying any taxes during year 6. In year 7, again, the the MCIT is greater than the RCIT. So the income tax due is equivalent to the MCIT, which is 40,000, and the tax payable is equivalent to 40,000. In year 8, so RCIT is now higher than the MCIT. So income tax due of 70,000 minus the 20,000 of excess MCIT from year 5 and the 20,000 from year 7 must be or may be deducted. So instead of paying 70,000, the company will pay only 30,000. So the following items could be noted in this example. So number 1, excess MCIT cannot be credited to MCIT. Second, the 20,000 difference of year 4 excess MCIT or the remaining 20,000 year 4 excess MCIT has already expired. So it only kumbaga it only justifies the position that uh, the the running of the 3 years, the running of the 3 years of carryover of MCIT was not interrupted, even though the um, even if the taxpayer is in MCIT possession. So the count of expiration is from year 5, 6, 7. So in year 7, the 20,000 already expired. So that's why in year 8, there is no longer a benefit. There's the company no longer has the benefit to claim the remaining 20,000 excess credits from year 4 kasi it already expired. So DTA for year 4. Year 4 ba dapat? So the excess MCIT in year 4 can be carried forward and credited against RCIT until year 7 only. Mali ata yung number ng year natin dito. Okay. I will just adjust the PowerPoint and send to you the revised one after this session. Okay. Aside from the MCIT, we have a deferred NOLCO is considered also as a deferred tax. So how to compute for the NOLCO and the deferred income taxes. So again, here are the information for the company. So during 2006, there is a net loss of 400,000. 2007, net income 100,000. 2008, 50,000 net loss again. 2009, 80,000 net income, and net income again of 350,000. The tax rate is 35% from 2006 to 2008 and 30% from 2000 and onwards. So in 2006, So this is the initial NOLCO. So we have a NOLCO balance of 400,000. In 2007, since the company is already in net income position, we can reduce the NOLCO, or we can reduce it by 100,000 of coming from the NOLCO. So from 400,000, the NOLCO, the ending balance of the NOLCO in 2007 is equivalent to 300,000. In 2008, again, the company encountered a net loss. So the amount of uh, taxable income is equivalent to 0. So this 50,000 will be added to the ending balance of the NOLCO. So from 300,000, it will become 350,000. In 2009, in 2009, the company is in taxable position since it earned, or it has a net income of 80,000. The company may reduce, or uh, may use his NOLCO balance to offset the net income and arrive at a zero taxable amount, since the company has enough NOLCO credits to deduct to the net income. So, that since the company has 350,000 balance, so they have enough NOLCO credits. So 350 minus 80 is equivalent to 230. No, 270. Tama ba? Tama, 270. Simpleng addition, nawawala ako. Tama, 270. So, however, um, since some of the um, NOLCO credits came from 2006. So 2007, 2008, 2009, it already run the 3 years carryover for the NOLCO. So the 270,000 minus the 50,000, which was just incurred last year, or equivalent to 220,000, must be, or is already expired in 2009. That's why the balance of the NOLCO uh, only amounted to 50,000. So that is net of the applied NOLCO and the expired portion of the NOLCO. In 2010, since the company has 350,000 income, the amount of NOLCO that can only be applied is equivalent to 50,000. Thus, instead of paying 350,000, the company is liable to pay 300,000. Okay. So, the amount of the DTA in 2007 must be recorded at 35,000, since the tax rate is during those times still equivalent to 35%, while the tax the DTA in 2009 was already taxed at 30%, since in 2009 there is a revision of the tax rate, lowering it from 35 to 30%. So in 20, the 220,000 is already unrealizable. Lastly, is to prepare the required disclosures. So the tax expense or income related to profit or loss from ordinary activities should be presented on the face of the income statement. So the income tax expense must be um, must be must be on the face of the profit and loss statement. The income tax payable must also be reflected as a separate line item in the balance sheet. There should also be a disclosure of the aggregate current and deferred tax relating to items charged or credited to equity. So for discontinued operations, tax expense relating to gain or loss on discontinuance, the results from ordinary activities of the discontinued operations, and the tax expense or income related to those changes in accounting policies and errors that are included in profit or loss because they cannot be accounted for retrospectively. As discussed, the application of tax laws are prospective. So whatever uh, whatever result may be uh, due to the accounting policies and errors cannot also be applied retrospectively for tax purposes. So here are some sample disclosure of current and deferred tax asset. So in the financial statements and the notes to financial statements, the current and deferred tax benefits must be uh, separately detailed. There must also be a reconciliation of the income tax computed at the statutory income tax rates to the provision of income tax as summarized. So, income or loss before income tax. So, this is at 30% already. No. The income tax, statutory income tax rate is 954 is at 30%. Then, um, permanent differences accounted for. So, there is may mali lang dito sa sa sample kasi change in deferred tax asset are temporary and difference between RCIT and MCIT are also temporary. The non-deductible expenses and interest income subjected to final tax are permanent differences. So, so the total is 3.3 million. So this must be equivalent to the income tax benefit summary. So this is why the next one is the components of the company's deferred tax assets. So that the reason why we need to prepare a schedule of deferred tax asset is for the disclosure to the FS. So we need to indicate the balances at the end of the year for the deferred tax assets or liabilities. So we need to break down the specifics, how much is for the NOLCO, how much is for the other expenses such as allowances, accruals, MCIT, provisions, etc. Also, um, movements in prepaid income tax must be presented. how much is the current tax expense minus the income taxes paid and the creditable with tax withheld. So this disclosure should tie up with the amounts reported in the annual income tax return of the taxpayer. Disclosure of the NOLCO, as discussed earlier, whatever was reported in the ITR must also be reported or disclosed in the details disclosed in the ITR must also be disclosed in the details in the notes in the income tax disclosure of under the notes to FS in the notes to FS. So the year incurred, the amount, how much was expired or applied, the balance, and the expiry date. This applies also to the MCI, wherein it was wherein the year of incurrence, the amount, the amount expired or applied, the balance, and expiry date was also disclosed in the was among the details that must be disclosed in the financial statements of the taxpayer. In addition to the FS disclosures, so the company or the BIR requires all companies to have or to disclose supplementary information in taxes and licenses under Revenue Regulations number 15 to 2010. So this in addition to the mandated disclosures under the PFRS, this information on taxes, duties, and license fees paid or accrued during the taxable year must also be disclosed. So this includes payments on payments or accruals on value-added tax, duties, excise taxes, documentary stamp tax, withholding taxes, and all other taxes and tax assessments and tax cases. Under the value-added tax, so the output tax, the amount of the tax declared in the VAT returns, the account title, and the amounts upon which the same was based must be disclosed. So, dapat kung ano yung naka-report sa VAT, must also be the same amounts reported or must also be the same amounts disclosed in the value-added tax. For considered or exempt, a statement to that effect must be also included. So there must be a narrative that there is a zero rated or exempt transactions plus there must be a legal basis or what was the legal basis being used by the taxpayer for such exemption. Next, in the income tax, the input tax must be broken down into the beginning of the year, the current year's domestic purchases and payments, claims for tax credit or refund and other adjustments, and balance at the end of the year. So duties, under duties, it shall include landed cost of imports, customs duties, tariff fees, excise taxes, the amount of excise tax per category that was paid on locally produced and imported excisable items. Documentary stamp taxes shall include payments of DST on loan instruments, shares of stocks, and other transactions subject to DST. Withholding taxes shall include tax on compensation and benefits, creditable withholding taxes, and final withholding taxes. For other taxes, this includes all local and national taxes, including real estate, license fees, permit fees, and all other fees that is lodged under the taxes and licenses account. Tax assessments and cases must also be disclosed. So the periods covered and the amount of deficiency tax, whether protested or not, and the cases and amounts involved under investigation litigation and or prosecution under outside BIR. So, pwedeng from Supreme Court or um, Supreme Court and Court of Tax Appeals. Okay. So, the reason why the income tax, income tax return and the FS disclosures, or the notes to FS must be, um, tawag dito, must be equal or must be the same. What was the amount being being reported in the ITR must be the same or at least similar to the ones disclosed in the FS. Why? For certain, for that is for BIR audits. So any discrepancy that the BIR would found out during their audit, discrepancy in the FS, discrepancy of items between the ITR and the FS would make or would open for certain disallowances, certain additional taxable or tax liabilities to the taxpayer.